Greg, did you see that mortgage rates went up again since the Fed opened their mouth?
Come on, John, you know better than anybody. When the Fed raises rates, it's good for mortgage rates.
Okay. Well, let's talk about that and more with our special guest partner, Greg. Hey guys, it's the Buy, Sell, Love SoCal team here, and we are back with another weekly market talk. But this week we have an amazing special guest speaker, Greg with World Mortgage Group, and we're going to have a chit chat about where the market is and what rates are doing.
Because you're a lot smarter than us.
Thank you for having me. Yeah, I mean, quick overview, the market's fantastic. Interest rates have kind of gone back to normal, which we were expecting.
Normal is what?
Normal is probably between 4 and 6%, somewhere in there.
Historically based on like what, like 10 to 15 years or whatever?
Yeah,
I mean, historically, I think 8% is the average if you look over 30 years.
Yeah, I mean, if we stay below 6%, then historically we're lower than the last
average,
30 years.
That's wild. So like 8% over 30 years?
Yeah, over the last 30 years, I think the average is 8%.
Okay.
I bought 11 years ago, and I think my rate was just under 5 then, but like,
Mine was 7.
you know how much my house
When I
has
bought mine
appreciated
out.
since then? So.
Do you still have 7?
No.
Okay.
Well, and I think that's the thing to remember too, is that mortgages are generally 30 years fixed, and the loan is fixed up front, but it doesn't mean you have that loan forever. So if you buy and rates go up, then it's great that you bought when you did. And if you buy and rates go down, you can always redo that loan and remortgage and take advantage of those lower rates. So
Absolutely.
either way you look at it, the market's always going to move and the rates are always going to move, but you can always improve your situation long term.
I feel like that surprised me when we bought, like I said, 11 years ago. The number of times that we refinanced since we've owned that house, I wasn't in real estate when we bought, and so I don't think I realized that was as prevalent, or that you could just we refinance like 8, 9 times.
Right.
And I have clients of mine that bought with you and have refinanced with you 3, 4 times in 2 years, and
yeah, and each time we do it, it gives us another way to look at the situation, look at their financials, make sure they're on track with retirement, make sure they're not accumulating debt. So even though you're refinancing to lower your rate potentially, there's also other things you can do to make sure that house is doing what it's supposed to be doing, which is building your wealth and building your children's wealth and creating that financial stability for you.
So looking at the whole financial picture for your clients.
Right. It doesn't necessarily have to be, hey, let's just lower your rate and lower your payment. There's always other things that kind of encompass that can help you build your retirement and build your future through the biggest asset you probably will ever have.
Let me throw a scenario at you. So I had a buyer that was getting frustrated, and they thought, well, what if I just take this $100,000 that I'm going to put down, it's like 120, and instead of putting it into a house right now, I put it into stocks right now because stocks are in the toilet.
Sure.
Where you had like a good analogy to that, like, because if I put $100,000
leveraging.
Yeah, so what's the
Right, yeah. So one of the most powerful things about real estate is leverage, and it's something that's not really talked about very often. But if you took 120,000 and put it in the stock market at 10%,
right?
If you're amazing at it and you bought at the bottom, you could make 12 grand a year.
Because that's 10% on the $100,000
on the money you put in, right?
Right.
Where with real estate, even through whatever crashes you might see or adjustments or appreciation, you're always going to earn 5 to 7% somewhere in there. But you're not earning 5 to 7% on your investment. You're earning 5 to 7% on the price of the home.
Right.
So if you bought $1 million home,
right,
you're earning $50,000 to $70,000.
So that's where the leveraging comes. Yeah.
Right. Your return on investment, I don't know of a better investment in the world, because you also get to live there.
Right.
And there's tax advantages to that. And so just from a standpoint of just utilizing your money, it's one of the best investments there's ever been.
And with housing stability, don't they say homeownership is the greatest way to combat inflation?
Right.
Keeping that stable.
Yeah, if you have that $120,000 in the bank, you're losing money. Because inflation's taking more than what the bank's not paying you anything anyway.
Right.
But real estate, even if it fluctuates, long term is always going to go up, and it's a fixed asset. You can't pick a house up and move it. And so that's the best hedge against inflation, against recession. Just from a financial wellness standpoint, there's really no better place to put your money.
So what are you saying to buyers that have been looking for 6 months and they were originally looking to buy when rates were way lower?
That's a tough conversation, because rates have definitely, like I said, they went back. They didn't necessarily go up, even though they did go up. It's really a matter of looking at their overall situation, because normally when rates go up, you'll see prices kind of calm down a little bit, and you might see some more options for buyers, so that's a plus. But at the same time, if the rate goes up to where the monthly payment perhaps went up $500, $600 from before, where can we take some of that asset that they have, or that cash they're going to use for the house, and pay off some other bills or some other debt they have, to where we can free up that money over here? A lot of clients I talk to, they want the lowest rate on the mortgage, and that's of course the plan, but they've got $30,000 in credit card debt at 22%. So why don't we shift the focus to taking care of some of this toxic debt and making sure that your best investment is taken in a way that utilizes the best going forward. So
I think my buyers are always surprised when they have that conversation with you, but it's so smart. I mean, I had Austin buying in Corona last year, and you had him like take some of his money and pay off his truck.
Right.
Or like the Warrens, you're like, okay, yeah, it's gonna be a higher rate, but take the $40,000 or I don't know, $40,000, $100,000, and save it in the bank because
Right.
you'll have 11 years worth of payments at that.
yeah, they were a little bit concerned. They felt like they were going to the top of their budget. And so instead of putting another 40,000 down and saving 180 a month, let's keep the 40,000 over here so that if times get tough, would you rather have 180 less dollars a month, or would you rather have $40,000 in the bank?
Wow.
Yeah.
You know, and that
that's
puts
smart.
them in a better financial position because they're young and they're getting started. And then as soon as the market improves, we can always rewrite their loan lower, and we still have that $40,000 asset to then put somewhere else potentially and help them grow their wealth. So
Totally.
a lot of different ways to look at it. You just always want to kind of look at the big picture if you can, and then structure things around that.
Yeah, I think that goes to the fact that sometimes you get buyers or clients that are so micro-focused on the rate and what's happening today. What am I paying for this loan today? That there is absolutely no forethought into what's 10 years,
Or
5
they're
years.
waiting for the market to crash.
Oh, I hear
Right.
that so much right now.
Right.
I'm
and
going to
that's-
wait for the market to
and
improve.
a lot of that is just that's the media. That's what they're
Right.
taught. A lot of buyers don't know what to ask, and
Right.
they're going
They're going to
what's the
say that
rate?
because
They
that seems
spit out
smart.
headlines.
Yeah.
Right. What's
Yeah.
the lowest rate? They think very short-sighted, and they think very narrow-minded, I guess, when it comes to just the overall picture. And so we just want to have a conversation with them just to open up that horizon and get them the lowest rate available anyway. But
Right,
what
that
else?
should be a goal. But yeah, like I've noticed, like with our clients specifically, like some of our like really seasoned investors, I mean, they've mentioned it to us that the market's turning and the rates are changing, but like they don't
Doesn't
really
really faze
care.
them.
They don't really care. Yeah.
Yeah, and most sellers, especially right now, if they've made $200,000, $300,000, $400,000, they understand.
Yeah, 40%
the-
gain.
yeah,
over
they understand the
COVID, yeah.
long-term benefit. Even if rates or prices came down a little bit, they've made so much money. They understand that the rate they started with, they probably don't have anymore. So the initial interest rate, while it's important, it's almost irrelevant over the life of the loan, as long as you're structuring everything correctly to help those clients down
Don't
the
think
road.
you're going to get into that house and just sit on it for somebody's not looking out for you if they let you just get into that mortgage and sit there for 30
Right.
years without ever doing
Exactly,
something with
exactly.
it.
Yeah, I mean, and it's a stressful time for people. It's the biggest investment they're probably ever going to make. It's the hard-earned money, but it's the best place for that money, and it's the best thing for that family. Whether they're just starting out or they're downsizing, any time in their life, it can be done in a way that really helps them out.
And what about things like tax benefits? Why, like a $2,500 monthly rental cost is not going to be apples to apples with
Sure.
the mortgage cost?
The higher the rates go, the bigger the write-off. And you've got property tax write-offs depending on, it changes for everybody depending on their situation, obviously at tax
Their
time.
financial situation.
Right, but typically when you buy a house, you can take more money out of your paycheck and not owe that money at the end of the year.
Because
right?
of the deductions
the
on
house will
the
offset,
interest
yeah, the
and-
write-off will offset that financial owe. So, yeah, if you're at $2,500 now and now you're at $3,500, it might feel more like $2,900. And now you own your home, it's a fixed cost, rents aren't going up because you don't rent. I mean, there's a lot of different ways to look at it. And then whatever money you put into the deal is now making 10x in return
Off
because
of
it's
the total price.
because it's off the total price.
Not
So
the-
it's the best time to buy was yesterday. Pretty much
Always.
know how.
Yeah,
It's
we
always
always
in the rearview
we've always
mirror.
said that saying time in the market is greater than timing the market.
It's one of my favorite.
Whenever we
ones.
tell people that,
Yeah.
they're like, "Oh, yeah."
Yeah, you don't wait to buy real estate. You buy real estate and wait.
And wait.
I mean,
Yep.
that's how you win. It's the easiest game in the world to win. You just have to be in it.
Yeah.
And the government and lenders and we're all trying to make it as easy as possible to get in.
Right.
So do you think that there's, to combat this market, I'm totally curious about this, are they coming up with creative financing again, or what kind of things are you seeing?
Yeah, yes and no. They're looking at longer amortization loans, maybe 40-year loans. But to get that loan, you've got to be better qualified than in the past.
Okay.
Adjustables are starting to come out, and adjustables kind of scare a
Like
lot of
I
people.
was
5-year
gonna
arm,
ask you
7-year
about that. I
arm?
keep
Right,
reading.
yeah, 7-year fixed and then adjustable after that. And the goal of a lot of those programs is to get you in at a cheaper rate and a lower payment, but then to work with those buyers for life to where before that loan adjusts, we put you into another product.
Yeah.
Because by that point, rates are probably lower or the same, but your income's higher.
You've improved
We've
your
worked with your
credit.
debt situation since you first bought, and now we can get you into a more stable loan, even though they're not like they used to be. in
So
terms of-
question on that, if somebody gets into a 5-year, 7-year arm, are they getting a fixed rate at the end of that period, or is it variable based off the interest rate in 5,
It'll
7
be
years?
it'll be fixed for the first, if it's a 7-year arm, it's 7 year
7 years
fixed,
fixed,
and
and
then
then
it'll become adjustable.
Adjustable
after
after
that.
And is that the
It
only
is.
caveat? There's no like balloon at the
There's
7
none of
year?
that
Okay.
stuff exists anymore. No, and that's
Okay.
a good thing. There's no, you can't pay interest only. You have to make the full
Oh,
payment.
I remember that.
And they're structured. A lot of people don't know this. When you buy, we look at what it could be at 7 years, and that's how we qualify you. So
Oh,
based on your
wow.
income now, which should only go up, you qualify based on a worst case scenario adjustment. So if you do get to that point, and for some reason we haven't been able to
That
get
is
you out of that loan,
Way more responsible
It's a
lending
much-
than we saw.
And we have clients that are like, we guarantee they're going to be moving, like in probably even 3 or 4 years, and we're just like 7-year arm all the way every day.
or even a 10, a little bit longer fixed period.
Oh, they have a 10-year.
It's cheaper than a 30
Oh,
year,
wow.
and it gives them that flexibility. And what we do is whatever your savings are per month, let's put that somewhere.
Is there a minimum down payment for those ARM programs? Is it only unconventional 20%
It-
down?
It's
or-
typically 10% or more
10%
to get
or
an
more.
adjustable, yeah. And then they'll go anywhere from 100,000 up to 100 million, just depending on where you want to go.
And what's a 7-year arm right now?
interest rate?
The interest
Probably
rate?
mid fours.
Okay.
Yeah.
May 18th.
Sorry, yeah. I'm just curious.
Yeah,
22.
tomorrow it could be
Yeah.
local.
In a-
I mean,
Whenever
Tomorrow
you're
it could be
watching this,
different.
yeah, and that's the positive of knowing the overall benefit of buying a home, whether it's your fifth or your first, is that the rates are going to do what they're going to do, and there's really nothing anyone can do about it. It's just such a global economy. Get you in, get the wealth creation started. We can always fix the loan later. Like in 20 years, I've still now no one ever come to me and asked to buy a mortgage, right? They're buying a house. That's the goal. The loan will always work itself out.
So last week in our market talk, Alyse brought up crypto and being able to use that. Are you having people come to you asking, hey, can
Greg was the one that was the whole.
It depends on the loan. If
Okay.
it's a Fannie Mae loan, which is your normal 30-year fix, up to about $1 million in loan amount, yes, you can use crypto.
for your down payment?
For your down payment.
Okay.
As long as it's been liquidated and you have it.
Season.
Does it have to be
Season.
seasoned for a period of time,
Not
or not
necessarily,
necessarily?
no.
Okay.
So
You
I
just
could
have to prove
liquidate it
where-
right now and then have the money.
As long as you can prove where it came from.
A paper trail.
Wow.
Yeah.
Right. Well, there are some crypto situations where they don't really do statements and it's a little hard to find out where it came from, so you can run into a wrinkle. But yeah, as that grows, you're going to see that adopted more and more. Some banks don't allow it because it's hard to source. It's hard to regulate because it's so new. But for the most part, you should be okay. And that's a place where you can earn big money if you do it right.
Yeah.
And if you can take that and then invest it into an asset like that's
A tangible,
that's
yeah.
that's a
right?
home run because that's a very volatile investment. Whereas real estate, it's just the
It's
name of the
not.
game. Just buy and wait.
Yeah. Fascinating.
Yeah, that's
Any
pretty good.
other?
No, I don't have
Anything
any
you
other
guys
burning
have?
questions. No.
Do you feel like you've been on the hot seat that we grilled you?
No, this is fun.
Anything you else want to share with us that you've heard, seen, we should know?
I think a lot of what you're hearing in the media is old news, and a lot of it is misinformation. I think a lot of it is headline grabbing.
I was going to say catchy headlines.
Yeah.
Yeah.
We're not headed into a crash. We're not headed into a real estate recession. It's just the numbers and the math don't add up. It's just not going to happen. It's
One thing you talked about in our office meeting was about the rate.
The Fed not
rate
correlating to you-
not
the rate that you
correlating. Can
provide.
we talk about
That's
that just
perfect.
because I
That's
think it's
one of the
important?
biggest misinformation. So right now the feds are raising the Fed fund rate, which is basically the bank's rate to go back and forth. And it affects home equity lines, credit cards, car loans. It doesn't necessarily affect mortgage rates.
So when the Fed raises 0.5%, are we going to see a 0.5% in mortgage rates go up that day?
If we did, it's not because of the Fed
Not
fund
because
rate,
of the- okay.
What the feds are doing is they're trying to raise the Fed fund rate, which is basically prime,
Offset.
to
inflation.
try to get inflation under control. They feel like they kind of missed the boat on inflation, and inflation's the tide that raises all ships. That's the biggest reason why rates are up. So if they can, in theory, keep raising the Fed funds rate, it should help bring inflation down,
It should actually have the counter effect.
and
yeah.
it should help bring rates down.
Right.
Yeah, and so, normally over the last few years that we've seen them raise the rates, it's actually helped mortgage interest rates. But that's a very complicated thing to wrap your head around.
So
and-
many people think, oh, Jerome Powell talked and he increased the rate, so interest
Right.
rates just
Yes.
went up. And
Right.
it's like, well,
U-
no.
Usually the Fed is behind the curve, so what they're doing is trying to stop the rates that have already gone up.
Yeah.
It's just you're not hearing about it until it looks like they're correlated when they're really not.
Yeah.
So every time the every time they raise that rate, it's not great for credit card loans and car loans, but it's helping bring it's helping bring inflation down, which is great for everybody. So it's actually a good thing. They just need to be more proactive about it and that will help rates also.
The government be more proactive?
That's a whole different half hour.
I'll save my commentary. Things to say about baby formula and I don't know.
Yeah, I think if you're working with the right team and you're motivated and you understand the whole process of why you're buying and what you're looking for, there is no reason not to do it, because you can always fix it if you have to down the road, but the wealth creation is just so powerful.
And my goodness, this is why, like, when I do a buyer consult, I mean, obviously a buyer that's coming to me and wants, if they have somebody specific that they want to use, they are welcome to use whatever lender they want. A lot of the time, thankfully, they have no idea. Or if they do have an idea, oh yes, I want to use Schools First because I'm a part of that credit union, I do my best to steer them towards somebody who can really guide them and look at all these things, because so many lenders
Because it's not black and
don't.
white.
It's not.
Yeah.
And so many are just selling you a mortgage and are not
Sure.
looking at this bigger picture thing, and you just do such a good job for our buyers.
And they may still go with their guy anyway, but there's never anything wrong with another opinion, just to make sure who
Absolutely.
you're working with has all the knowledge
Yep.
and that they know what they're getting into and they're prepared.
Smart things like attacking other debt, things that, you
Yeah.
know, Wells Fargo may not actually even think
They
about.
like
Yes.
that. They don't want you
They,
to
they want your credit card debt,
I know.
right?
That's
Yeah.
They
the
hold
Yes,
that note on your car.
Right,
so.
weird. Cool. Well, thank you so much
Thank
for
you,
joining us.
yeah.
Anytime. I appreciate it.
All right.
Yes, thank you so much.
Thanks, guys.
Okay,
Tune in
guys.
next
Yep.
week.
See you next
Awkward
week.
that-
ending.
Hit that subscribe button.
Is it like this? That's
like-
only up. Like button.
I'm trying to get their attention.
Subscribe.
Oh, okay.
Okay. Okay, bye.